Most business owners have a variety of assets in their corporation. They might own some real estate, maybe they have some stocks, some private investments. They might even have just cash, right? They're just building up their retained earnings, all of which have their perks, and I'm a big fan of. I'm a big supporter of diversification. I think you should own real estate. I think you should have stocks, and I think you should have money sitting in cash. What I'm going to suggest is adding an asset to your portfolio, not replacing, not displacing, but adding an asset to your portfolio. And the asset I'm talking about is a tax-exempt whole life insurance policy. Now, these policies are special in nature. You don't have to die for someone to benefit. There is a living benefit to these policies that can benefit you personally, your corporation, and of course, your family. So I'm going to walk you through just a high level, some of the points I think are important to know about a tax-exempt whole life insurance policy. So number one, the obvious point, yes, it is a form of life insurance, but it is a form of permanent life insurance, meaning the insurance lasts forever, the price doesn't increase, and you're going to have this policy for the rest of your life. So that's a good thing. It's going to be a tax-free payout to your beneficiary, which could be your spouse, your children, it could be your corporation, it could be a charity. Whoever you choose is going to get a tax-free payout on your policy when you pass away. So that's kind of point one, and that's the obvious point. The maybe not so obvious points of a tax-exempt whole life insurance policy are more around the living benefits, the investment part of these type of policies. And the investment is called the cash value. So in these tax-exempt whole life insurance policies, there is something called the cash value. And that is the investment part that builds up year over year as you're investing money into these policies. So the first thing to note about the cash value is a portion of it is guaranteed to increase every single year. So not too bad. It's in the contract you sign with the insurance company. It is guaranteed to increase every single year. It is also guaranteed not to decrease every single year. And those are two very different points, although they might sound the same. If something is guaranteed to increase, that's great. But if the next year it decreases or decreases more than it increased the year before, that's not so helpful. This is like a set of stairs where every single year as it increases, that is the new level. That is the new step. It cannot go down from where it is at. So it's a very safe, I would almost say worry-free investment where you know that whatever's happening in the stock market or the world, your money is not collapsing inside of these policies. The next point is that it grows on a very tax-efficient manner. So the insurance companies can pay dividends every single year into these policies. And as your policy receives the dividend, whether it's personally owned or corporately owned, your policy is growing without you having to pay tax on that growth year over year. So there's no T3s, there's no T5s, even though you have something that is growing in value, growing in worth, and receiving dividends. So that's a pretty good feature as well. It's also very flexible with payments, meaning you could choose to pay monthly, you could just do once a year and pay annually, you can pay more some years, pay less the other years, you can even skip years if you wanted to. So it's flexible to kind of work with your cash flow and what's going on in your personal financial world. The cash value and the investment is also very liquid. So that's kind of the number one concern I find people, business owners, individuals thinking about when they buy these policies is my money going to be locked up? You know, I have the life insurance, or, you know, I get that I'm buying life insurance, but I don't want all this money to be locked up in an insurance policy and I don't really know how to get access to it. Well, that's not true. The cash value is very liquid, and there's a few ways to get access to it, and many of the ways can be done on a tax-free basis. So if you're a business owner and let's say you've built up $2 million in that cash value and something came up business-wise, an emergency, you needed a couple $100,000 as quickly as humanly possible. You didn't want to have to go to the bank. You didn't want to have to go to third-party lenders. You could call the insurance company, get a policy loan against your cash value for a couple $100,000, and as long as it's not above the ACB, it would be tax-free, paid to you in literally several days. Now, in that same scenario, if you had $2 million in the cash value and you wanted a bit more than just a couple $100,000, maybe you wanted $1 million, maybe you wanted $1.5 million, maybe you wanted the full $2 million. Maybe you have $2 million sitting in the corporation and you want to take out or get access to $2 million. Well, you can do that as well. And you can still do that on a tax-free basis. In this example, it might make more sense to go to a third-party financial institution, and it could even be your bank. And what they would do is use the cash value as collateral and give you a tax-free line of credit against this collateral. Now, to get up to 100%, you might have to put up additional collateral. There might be some financial underwriting. There's other things to consider in a strategy like this, but just know that it is possible. Now, as a business owner, you want to make sure you have some liquidity in your assets, right? Emergencies come up, things come up. You want to make sure you have access to capital and tax efficient capital, preferably, should something come up. So the tax-exempt whole life insurance policy can certainly help solve an issue that comes up and help solve that problem. Now, on the flip side of things, as a business owner, you might be looking for strategies to provide yourself with tax-efficient personal income. So now the matter is not so much in the corporation, or the need isn't so much in the corporation, but the need might be for you to buy something personally, or for you to provide yourself with tax-efficient personal retirement income. In this example, what you would do is you'd still have the policy owned in the corporation. The corporation would be investing and paying for it. It would be the beneficiary. But at the point you maybe want to retire or start providing yourself with tax-efficient personal income, you would take the cash value, you would go to a third-party institution, and you would use it as collateral. They, in return, would provide you with a tax-free line of credit against the cash value that you can use personally at your discretion. Now, what you've just done is you've accessed money that was sitting in the corporation for personal use, and you've done it in a very tax-efficient manner. Now, with a strategy like this, there are many things to consider. There are things like guarantee fees that need to be paid back to the corporation. You need to consider underwriting, perhaps additional collateral put up, and many other financial risks need to be considered. But from a high-level perspective, that's how it would work. Your corporation would invest in a policy, be the owner, be the beneficiary, and once you build up the cash value enough, or you want to use it as collateral to obtain either a business line of credit or a personal line of credit, you can do so, pending the other variables I've talked about and things to consider, but it can be done. Now, one thing to note, this line of credit you're obtaining either through the business or personally, that can be paid off from the life insurance proceeds. So if you've obtained $1 million line of credit against the cash value and your life insurance policy is worth $4 million, if you were to pass away, they would just deduct the $1 million line of credit against the $4 million death benefit, and $3 million would go to your beneficiaries. So it is optional to have the life insurance proceeds pay off whatever is borrowed, or of course you can pay off what you've borrowed during your lifetime. Tax-exempt whole life insurance is about more than just the death benefit. There is a living benefit. You should use it. I encourage you to use it during your lifetime. You don't have to just die for someone else to benefit. It is what I like to say, the financial Swiss Army knife of investments. It can do a lot of things, but you have to know how to use it properly. Thanks for watching.